Hi, my name is Paul, and welcome to month number 5 of my $100 per month Canadian stock portfolio series. This time, I'm going to be breaking down Morguard and MTY Food Group's first quarter financial reports and conference calls, and I'll also be talking about why I expect Morguard to outperform in the event of a housing crisis or recession, since there's practically an inescapable rampancy of commentary on how Fed rates are going up and everything else is going to go down. So I'll be shoveling my own, hopefully insightful opinions on that topic. And as always, I'll also be showing you how the portfolio has performed over the last month with comparisons to the benchmarked indices. And of course, I'll be showing how I'm going about investing this month's $100 of capital contribution and the dividends earned over the previous month. So just like April, I'm going to go ahead and skip over the goals and rules since they've already been outlined in multiple episodes. But if you want to see the goals I've outlined for the series and the rules that I've set out for the portfolio, then there's a document linked in the description of this video that explains all of that in detail. With that said, let's quickly go over a brief recap of the companies that I hold within the portfolio. The largest holding is the Morguard North American Residential REIT, ticker symbol MRG on the Toronto Stock Exchange. There are two other Morguards on the TSX, so make sure you're looking at the right one. It has the ticker symbol MRG. And Morguard owns and rents out apartment units in cities and large suburbs throughout the US and Canada. The reason I've been investing in Morguard is because I believe it is heavily discounted when comparing it to its peers, and because it operates an easy to understand business that I believe will continue to grow returns for a very, very long time into the future. Last month, I invested over $79 of the $100 of monthly contribution into Morguard because it's my strongest conviction in the market. The next largest holding in the portfolio is Knight Therapeutics, which trades under the ticker symbol GUD on the Toronto Stock Exchange. Knight is a specialized pharmaceutical company that predominantly operates in Latin America through the licensing, marketing, and distribution of pharmaceutical drugs. The decision to invest in Knight Therapeutics was centered around a special situation involving a historically successful management team that specializes in acquiring undervalued pharmaceutical drugs and growing them much larger. This situation involves what I believe is an outsized reward for relatively low risk, stemming from Knight's loans to biopharmaceutical companies that allow Knight exclusive rights to purchase, market, and distribute successful products developed by the borrowers. Last month, out of the $100 of contribution, I spent $10.40 purchasing 2 shares of Knight Therapeutics. The smallest position that I hold in the portfolio is MTY Food Group, ticker symbol MTY, which also trades on the TSX. MTY operates and franchises fast food, casual dining, and other specialty restaurants internationally, though mostly in the US and Canada. In addition to that, MTY also sells and distributes retail food products. Like Knight Therapeutics, MTY Food Group has a history of strong success in acquisitions thanks largely to founder-led guidance and strict cash flow focused strategies. These consistent and successful acquisitions have propelled the company into becoming the best long-term compounded EPS grower of any of its competitors. Despite the amazing shareholder returns, MTY's premium growth has been shunned, and it currently trades at a lower earnings multiple than even the slowest growing of its peers. So last month, I decided to invest just under $11 of the $100 into MTY. That's it for the business operations summary of the holdings within the portfolio, but if you do want a more in-depth breakdown of my reasonings behind these investments, then I'd recommend you go back and watch the first 2 episodes of the series. You can find these videos within the monthly portfolio playlist, which contains every single episode of this series in order, and a link to that playlist will be available in the description of this video. Now, let's take a look at the important news that came out over the course of the last month or so. First, we're going to get Knight Therapeutics out of the way since it was the only holding that didn't post earnings over the course of the last month and didn't really have anything newsworthy to talk about aside from announcing that their earnings release and conference call will be on May the 12th. Moving on to MTY, they released their annual report that includes graphics, and they did have a note on the minor decline in free cash flow over the previous fiscal year. But all they really had to say on the matter was that it was in line with the previous years and higher than the pre-pandemic levels. Aside from that, the company also reported first quarter earnings on April the 8th, and things looked pretty good. Firstly, the company had solid revenue growth of 18% over Q1 of 2021, which was mainly attributable to Canada's franchise and corporate-owned operations benefiting from the easing of pandemic-related regulations. Also worth mentioning was that food processing, distribution, and retail revenues increased by 27%, most of which was organic growth driven by new listings in retail and geographic expansion. It was also noted that within the quarter, 175 total MTY branded products are being sold in the Canadian retail market, which is up from Q1 2021's 147 products in stores. It was also mentioned that the decrease of $5.7 million in US corporate location revenues was due to the sale of several Papa Murphy's corporately owned locations in the prior quarter. As far as profitability goes, net income was up 24.2% and free cash flow per share was up 22.7%, yielding $1.51 in free cash flow per share. This is particularly good news for a few forward-looking reasons. Firstly, because of COVID-related issues, there were headwinds affecting the company's performance in this quarter. During Q1, there was again a net closure, this time of 15 locations, which, at least, was a significant deceleration from Q4's 129 net closures. Additionally, in Q1, 225 locations were closed one or more days during the quarter, some of which coming from confirmed COVID cases at locations leading to temporary shutdowns, or locations that are slower to reopen, like some located in malls, gyms, airports, and universities. In the conference call, there was also mention of a franchisee company that operated several locations, which was forced to dissolve within the quarter. Other COVID-related issues like job vacancies, inflation affecting wages and pricing, and increasing supply chain costs also impacted business. But despite these issues, the company had a strong quarter, and many of these challenges are expected to ease up over the coming year. In April, MTY also released a new investor deck presentation which highlights that consumer demand for MTY's top categories in Q1 is typically at its lowest. So, barring any further irregular impacts on business, MTY's remaining 2022 quarters should yield even better results. If this is true, then we can probably assume that free cash flows per share throughout the rest of the year will likely be at least on par with the $1.51 generated in Q1. This means that we can probably expect a $6.04 free cash flow yield per share on the year. If that's the case, then the company is currently trading at a 2022 price to free cash flow of around 8.75, which to me appears to be a very good value. Now, let's talk about how the company has been utilizing this cash flow. Throughout Q1, MTY repurchased for cancellation an additional 256,400 shares for roughly $14.6 million, and they repaid $10.1 million in long-term debt. Management has also been talking about innovating to improve customer experience with mentions of improving brand websites, and on the conference call, the CEO mentioned that the company is focused on generating organic growth while actively seeking potential accretive acquisitions. And since the onset of the pandemic and the amount of debt that was repaid since, it was noted that the company is considered financially well positioned to seize quality acquisition opportunities that are presented to the management. That said, Eric Lefebvre did state that his intention was to remain disciplined in the search for the right acquisitions at the right price and with the right synergies. And he also elaborated further by stating that he's not afraid of making proportionally large acquisitions, with a brief mention to an unnamed mentor, which I'm assuming was a nod to the former CEO Stanley Ma, or possibly other historically great capital allocators who have employed similar strategies like Henry Singleton or Warren Buffett or any of the other great CEOs written about in William Thorndike's Outsiders, which is a hugely underrated book that I believe every aspiring investor should read. In line with the reasoning of other great capital allocators, Lefebvre claimed that if he can't find acquisitions that meet his investment criteria, then the company is happy to repurchase shares at the current levels. And that was it for MTY. So now it's time to talk about the Morguard North American Residential REIT, who, aside from declaring their usual monthly dividend, also released their Q1 earnings on April 26th. And almost everything was as I had expected, aside from a couple of surprises that were hinted at in the annual call. But before we get into that, let's start with the numbers. So both US and Canadian occupancy made upward moves throughout the quarter, despite the continued impact of COVID and stay-at-home restrictions, which have been disrupting normal leasing patterns in Canada specifically. Especially impacted were the properties in Ottawa and Edmonton, within a close proximity to the respective universities, since many students are still completing their online programs and aren't expected to start returning to in-person classes until September. So this is expected to continue to negatively impact occupancy through to Q3. Still, average monthly rent per unit increased in Canada by 3.1% compared to the first quarter of 2021. Meanwhile, same property average monthly rent per suite in the US increased by 9.6%, again compared to Q1 of 2021, with a note in the report that Morguard saw AMR growth in all US properties. This increased average monthly rent across the board pushed revenues, net operating income, and funds from operations higher, while pushing the dividend payout ratio as a percentage of FFO down to 53.8%. With regards to Canada specifically, the REIT experienced rental rate growth from changes in regulatory guidelines, with previous restrictions preventing any rent increases over the prior 12 months to be lifted at several properties. It was noted, however, that in order to reduce the burden on tenants, the REIT decided to stagger rent increases on affected properties throughout the months of January to March, instead of increasing rents all at once. Though on apartment unit turnover, the REIT saw an average AMR growth of 15.5%, and these higher rates of AMR due to turnover accounted for 3.7% of the total Canadian suites. In the United States, a lack of supply and increased demand for single-family homes saw many homeowners choosing to sell their properties and turn to renting. This increased rental demand and average monthly rent per unit. And as of now, there is no sign of struggle to pay the rising rental rates, as the REIT's collection of rental income throughout the quarter was materially in line with historical collection rates. Now, the increase in net operating income was pushed by US properties, which saw an increase of 111.6%, mostly generated from overall higher demand and a relatively light Q1 2021 comparison, during which the Louisiana redevelopment property was not completed, and this property is now operating at stabilized occupancy. Meanwhile, Canadian properties had a slight net operating income decrease of 3.2% because of increased costs associated with in-suite repairs and cleaning, higher insurance premium costs, increases in payroll, higher realty taxes, and higher utility costs. Now, everything up to this point has been pretty standard fare, but it's time for us to get into the surprises. In the report, it was mentioned that subsequent to the quarter's end on March 31st, 2022, the REIT entered into a conditional agreement to sell two properties. One located in Atlanta, Georgia, comprising 292 suites for $75.5 million excluding closing costs, and the other located in Slidell, Louisiana, comprising 144 suites for a total of $24.28 million excluding closing costs. These deals are expected to close in the second and third quarter respectively, and are contingent upon the mortgages on the properties, currently totaling $29.282 million, being repaid. For me, this was a very positive surprise, since the sale of these properties will unlock some of the illiquid book value at a heavily discounted rate relative to share price. To put these deals into perspective, the company will be bringing in $70.5 million in cash after paying the mortgages for selling 436 apartment units, excluding the closing costs. This represents a cash influx equal to about 9.3% of the current market cap after converting to Canadian dollars, for selling under 3.6% of their wholly owned apartment units. But this isn't the extent of the good news pertaining to these divestitures. In the conference call, it was noted that the REIT decided to sell these properties because of unprecedented demand, leading to purchase offers at cap rates in the 3% range, which just means that assuming current levels of net operating income on these properties, it would take somewhere between 25 and 33 years to achieve a 100% return on total investment from these properties. Additionally mentioned in the call was that these were among the oldest properties within Morguard's portfolio. So, a really great job by Ray Sahi for pulling together these two deals. I think they're going to be very beneficial to shareholders. So, what's going to happen with all this added cash? Well, I'm not too positive, but I don't think it's going to go towards repurchasing shares, despite the open NCIB opportunity, since management has already had plenty of opportunities to buy shares at and below current levels, but have chosen not to, though they did mention that it is of consideration on the quarterly call. Also on the conference call, it was noted that the company's main focus is on actively seeking out new acquisitions, specifically within the US, and it seemed like they may have had something particular in mind, but they were unwilling to speak on the subject in more detail when questioned. Another possibility is that the REIT is expecting interest rates to rise and are looking to use the cash to settle up some of their mortgage debt while money is still flowing cheaply, especially when considering the sizable portion of mortgage debt coupons that will be maturing through to 2036. This could be a possible, more conservative reason for not repurchasing shares, though this is entirely speculation on my part and should be taken with a grain of salt. As far as tangible book value per share goes, this once again rose sharply, thanks largely to increased property values, which boosted this up to $41.62 per share from $38.01 per share in the previous quarter. And this represents a 9.5% increase over Q4. Seeing these massive increases in the value of real estate, specifically revolving around housing, It's no wonder that fears of a market collapse have been building up, especially when considering the rising Fed rates. And this notion does have some validity in my mind. I think that the Fed rate increases will make it harder to borrow money and will likely lead to less people buying homes at the current inflated prices. So this should raise the question, if I believe that home prices are going to come down, then why would I be investing in a residential real estate investment trust? Surely this isn't a good idea, and I'm going to get crushed, as some of my viewers have pointed out in the comments of my videos. But I don't believe that this is the case for two reasons. The first being the discount rate on MRG's current share price. See, Morguard shares trade at a discount of $23.90 per share when compared to its net asset value. And this is before considering the sale of its two properties, which are in the process of selling at a premium to their appraised values. This means that Morguard's shares would need to increase by over 134% in order to reach the current market value of its properties. But more importantly, this means that the market would need to see a decline of over 57% in order for Morguard's shares to be considered overpriced on a net asset value basis. Never mind the fact that this would push the mark-to-market cap rate on its properties to over 16, meaning that Morguard's properties would be returning over 16% per year, assuming no growth. Though this does also assume that rents would not drop, which we'll get into in just a moment. But I first want to point out the unlikeliness of a 55+ percentage point drop in today's real estate prices. To do so, we're going to take a look at the Federal Reserve economic data on the housing market during the Great Recession in 2008, which was centered around the housing bubble that was propped up by fraud, low interest rates, and absent regulation. From crest to trough, the All Transactions Housing Price Index, which measures changes in single-family home values based on the data from all 50 states and 400 American cities, declined from 380.86 to 308.76, representing a decline of about 19%. Alternatively, the S&P Case-Shiller U.S. National Home Price Index, which measures the value of single-family housing within a composite of single-family home price indices for 9 U.S. Census divisions, calculated monthly, declined from 184.599 to a low of 136.528, representing a decline of about 26%. So that means that in order for a real estate crash to break down MRG's discount to net asset value, the crash would have to be more than twice as impactful as the Great Recession, which was again largely brought on by a lack of regulatory oversight, something that is currently in place today. Now, we do currently have the added negative of excess stimulus money sloshing around and rising federal interest rates. But short of some major black swan event, I'm struggling to see how the housing market ends up reverting back to levels that we haven't seen since 2003. And the idea that the Fed raising interest rates a few percentage points is going to be enough to do this alone just doesn't really seem very likely to me. And personally, I don't even think we'd end up dropping below early 2019 levels in a semi-plausible, near worst case scenario involving an overcorrection. And that would be at most about a 30% decline. Though I will state that I'm no economist, so feel free to blast me in the comments if I'm missing something here. Criticism is encouraged. That said, even if a major crash were to happen, this is where point number 2 comes in. Rent prices generally don't experience significant drops during periods of recession or during housing crashes. Now, this might sound contrary to your initial assumptions, because surely if real estate prices drop and less people are earning a sufficient living wage, then rent prices would obviously have to fall in line with that, right? Well, as it turns out, this is wrong. Taking a look at this chart created by the Center on Budget and Policy Priorities using data published by the Census Bureau's American Community Survey, you can see that during 2008, when home prices were crashing, the median cost of rent in America was actually increasing at a faster rate than in the prior years, only starting to slide slightly from 2009 to 2012. But even still, the median rent prices never dropped below 2007 levels, which was during the period of high rising home prices. So let's try to logically understand why this is the case. To help with this process, I'm going to use a made-up person who we'll call Frank. And Frank will be experiencing a series of unfortunate events, and he's going to try and struggle his way out of them. See, Frank works as a window manufacturer in a small town an hour or so drive from the city. Frank's wife works at the car factory in the same town, and together they have 2 kids and they live in an affordable home that they rent for a good price. After seeing a few of Frank's friends flip houses for several times Frank's annual salary, in a matter of months no less, Frank decided to take advantage of the cheap debt available by maximizing his leverage and using his family's savings as a down payment on an expensive home that they wouldn't have otherwise been able to afford. But housing prices had only seemed to be going up, and the family would be able to move in, meaning they wouldn't have to pay any more rent, at least until next year when Frank planned to flip the house for a six-figure profit. Unfortunately for Frank, this was in late 2007, and when his planned sell date came around, the housing market had already collapsed, and his investment had declined in value by nearly 20%. If Frank decided to sell now, this would lock in a six-figure loss, and Frank doesn't have anywhere near enough money to pay off the difference remaining on his mortgage. So Frank's only option was to continue paying the monthly mortgage bill and wait for things to get better. Sadly for Frank, things would not get better. And a few months later, the window factory that he worked at made the decision to lay off Frank and the majority of his coworkers because no one was building homes anymore and the company just couldn't afford to pay wages without new contracts coming in. This put a huge strain on Frank's family's financial situation, and they were starting to struggle with the bills. A month later, and all hope of Frank's investment dreams would come crashing down. Frank wasn't able to find work anywhere in town, and his wife's hours at the factory were cut back because people were buying less new cars than they had been in the years prior when the economy was in full swing. Within a month, it became very obvious that they wouldn't be able to pay the mortgage bill if they wanted to also have food on the table. So Frank and his wife filed for bankruptcy and the house was foreclosed on, leaving them flat broke with nowhere to live. Now, if you were in Frank's position, what would you do? Would you choose to accept a life of destitute homelessness and live on the street because you can no longer afford to live in your own home? Or would you head to the city to find work and rent an apartment so that you can provide for your family as best as you can? If you're in Frank's situation, you're probably going to do what's best for your family, who, by the way, is also probably going to be renting a cheap apartment in town where Frank's wife still has her job, despite the reduced hours. Now, imagine that there are thousands of people like Frank who have lost their homes and jobs during a recession. It stands to reason that they aren't going to be buying another home anytime soon, and they probably aren't going to consider the option of living on the street or finding a spot at the homeless shelter too seriously. Which only leaves two possibilities. Find someone capable and willing to take you in, which won't be an option for everyone, or find a cheap place to rent while you try and get back on your feet. This should help to illustrate that when people lose their homes, they'll generally turn to renting. And with increasing demand for places to rent, could we realistically expect the prices of rent to drop during a period where housing development projects are usually not being built? The answer is no, which is why a REIT like Morguard, whose sole business is centered around renting out apartments in cities and major suburbs, is incredibly well positioned should a recession or housing crash come. And should a future crash significantly lower Morguard's share price, I'll be a very happy buyer at what will undoubtedly be an incredibly discounted price to net operating income. But that last bit is my own 2 cents. Hopefully you found Frank's story informative and useful in your understanding of why rents don't generally fall during times of recession. Anyway, now it's time to break down the monthly performance of each security and the overall portfolio. Starting with Morguard, last month I bought 4 shares for $19.78 each, and over the course of the month, these shares declined by a whopping 10.41% to $17.72 before accounting for the dividend that was paid. When accounting for the dividend of 5.83 cents per share, this slightly improved Morguard's decline to a negative 10.12% as of market close on Thursday, May 5th, 2022. Next was Knight Therapeutics. I bought 2 shares of the company at $5.20 each, and over the course of the month, the share price increased by 2.31%, ending the month at $5.32 per share. And lastly was MTY Food Group. I bought just under 0.2 shares of MTY for an average share price of $54.84, and this fractional buy dropped in value by a total of 4.1% over the course of the month. So as of May 5th, April's invested capital has declined in value by 8.41%. As for the entire portfolio, last month's decline leaves us with a total equity value of $381.03 on a contributed capital of $400.70 of capital from dividends, giving the total portfolio a net unrealized loss of 4.91%. So this was a pretty brutal month in the markets, but let's check the 4 ETF benchmarks to see how they managed to stack up. And I'll say now that over the course of the month, the public portfolio again underperformed all the benchmark index funds. The S&P 500 index, VFV, was the worst performing of this group, outperforming my portfolio by 3%. Next was the Canadian All-Cap ETF, ticker symbol VCN, which beat me by 3.54% when accounting for the dividend paid. The Canadian Large Cap ETF, with the ticker symbol VCE, was the next best performer, achieving a 6.24% outperformance of my portfolio when accounting for the dividend paid. Finally, the best performing index over the April investment period was the Global Value ETF, ticker VVL, and it outperformed me by 6.28%. Since inception, which has been about 4 months now, if I'd invested $100 per month into each of these indices as well as my own portfolio, the results would be as follows. The worst performer would have been the S&P 500 portfolio, which would be worth $376.20, representing a 5.95% loss. Next would be my monthly portfolio, which is currently worth $381.03, representing a 4.91% loss. In third place is the Global Value Index, which would be worth $389.27, showing a loss of 2.68%. The second best performer would be the Canadian All-Cap ETF, which would be worth $389.34, representing a 2.67% loss. And finally, the top performing portfolio would be the one holding the Canadian Large Cap ETF, which would be worth $391.64, representing a loss of 2.09%. So for now, my portfolio is still ahead of the S&P 500 by about 1.27%, but I'm trailing the rest of the benchmarks by a range of 2.16 to 2.78% after a period of 4 months. But like I said last time, we're still basically at the beginning of the portfolio, meaning that gains and losses are more likely to be attributable to market variance rather than good or bad capital allocation decisions. Given a period of a few years, however, it should become more clear as to whether or not my investment hypotheses are accurate and whether or not they actually produce quality results. Until things play out, though, I'm just going to say that the entirety of my performance so far can be chalked up to nothing more than luck. So now it's time to choose how I want to invest this month's $100 as well as the 70 cents in dividends from Morguard. And once again, I'm going to be doing pretty much the same as last month with one slight change. I still plan on buying 4 shares of Morguard, but I'm only going to be buying 1 share of Knight Therapeutics, and I'll be investing the remainder into MTY Food Group because my conviction in MTY has risen, and I believe it's more likely to produce a better long-term return than Knight Therapeutics. That said, I'm not 100% confident that I'm buying the absolute best deals in the market at the moment, mostly because April was an incredibly busy month for me personally, and on top of that, the markets declined precipitously in the past few trading days. So I'd imagine that there are plenty of other great discounts out there waiting to be taken advantage of. Noting that, I do still think that the current lineup is trading attractively. Still, over the coming month, I will be doing more analysis on different securities, which may turn up something new, or it may further bolster my opinions on the portfolio's current holdings. Either way, let's jump into the clip of me buying shares. Alright, so we're back in the Wealthsimple account here. We have $100.70 to invest, and we're going to start off with buying our 4 shares of Morguard. We're just going to buy it at market price, which looks like it'll be about $18.01. So per share. So let's buy that. Continue, confirm. And let's make sure that that went through. And we got our 4 shares at $17.99. So saving that extra 2 pennies per share. Next up, we're going to buy our 1 share of Knight Therapeutics. And we're just going to market buy that. And it has completed for $5.33. And last thing that we want to buy here is our MTY Food Group, which we're just going to buy a fractional share of, and we're going to spend all that $23.41. And we should be getting 0.44 shares, but we'll know in a little bit, and I'll get back to you once that is done, because usually it will say pending, and yep, it is pending. So I'll come back to you when I have that information. Okay, and once again, I am back, and it's just a little bit later on in the afternoon, and I have received confirmation that the MTY offer has been filled at just past 3. So my $23.41 was able to purchase 0.4434 shares for an average share price per whole share of $52.79. So I'm going to punch that into the spreadsheet, and I'll see you back in a sec. Okay, so taking a look at the portfolio after having invested this month's allotment and after the market close on Friday, May the 6th, the portfolio now holds 20 shares of Morguard worth $354, making up 73.87% of the portfolio. The second largest holding is Knight Therapeutics, of which I now have 12 shares worth $63.84 and making up 13.32% of the portfolio. And the smallest position is MTY Food Group, of which I have 1.17 shares worth $61.35. And this makes up the remaining 12.8% of the portfolio. Also, we once again have no cash remainder left in the portfolio at the end of the month. Now for the distributions. This month, the portfolio received a distribution from 12 shares of Morguard, raking in 70 cents, and we again passed the ex-dividend date for next month's payout, with a qualifying 16 shares of Morguard, which should bring in 93 cents. MTY Food Group is also expected to pay a dividend this month, and at the ex-dividend date, my account held 0.7281 shares of the company, which should pay about 15 cents in dividends. By adding these two payments together, I can expect total proceeds from the distributions to equal $1.09, which will push the total cumulative dividends earned within the portfolio to $2.26. Moving on to the yield on cost chart, over the period of a full year, looking forwards, if I continue to hold my 20 shares of Morguard, which pay me a monthly distribution of 5.83 cents per share, I can expect to earn roughly $13.99 annually for a yield on cost of 3.73%. MTY Food Group is also expected to pay me an annual 98 cents in dividends on the 1.1715 shares that are held within the portfolio. The current yield on cost for the MTY shares is still at 1.58%. When combining MTY's dividend with Morguard's, I get a total expected annual return from distributions of $14.98, since Knight Therapeutics is not expected to pay any dividends anytime soon. This leaves the monthly portfolio with a current yield on cost of 2.99%, which of course assumes no changes to the current dividend payments or number of shares held. And that's all that I have for you this month. So remember that the information presented in this video should not be taken as financial advice, but instead it should be used as a starting point for you to do more research into a company that interests you. None of my videos cover anywhere near enough information necessary for you to make a good investment decision on individual securities. I only make these videos to provide inspiration and insight into my own personal decisions when investing. I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others, and in doing so, I hope that I was able to provide you with some value. And if I did, then please consider sharing with someone else who may benefit from it. Thank you for watching all the way to the end of the video, and enjoy the rest of your day.